Imagine waking up one morning to find that a significant portion of your investment portfolio has vanished overnight, leaving you with a fraction of what you once had. Sounds like a nightmare, right? But for many investors, this scenario played out in real life when they failed to recognize the risks associated with a seemingly innocent trade. In 2008, the global financial crisis triggered a massive sell-off in the stock market, wiping out trillions of dollars in investor wealth. One of the most notable examples was the collapse of Lehman Brothers, which had been a stalwart institution on Wall Street for over a century. But what's even more shocking is that there were warning signs months before the actual collapse. In fact, analysts and investors alike were sounding the alarm about the company's precarious financial situation. However, many investors chose to ignore these warnings or underestimated their significance. They continued to invest in Lehman Brothers, convinced that its assets would somehow magically bail out the company. Well, we all know how that turned out. The consequences of this failure to act were catastrophic: tens of thousands of jobs lost, entire communities devastated, and countless investors left financially ruined. Now, you might be thinking, what does this have to do with me? But here's the thing: history has a way of repeating itself. In recent years, we've seen similar collapses in high-profile companies like Enron, WorldCom, and even our own government-backed institutions like Fannie Mae and Freddie Mac. The problem is that investors often fail to recognize these risks until it's too late. One such example is the case of David Einhorn, a renowned hedge fund manager who made headlines in 2013 when he predicted the downfall of Herbalife, a nutrition supplement company. Einhorn was correct, but his clients weren't so lucky. Many had invested heavily in Herbalife, unaware of the risks that lay beneath the surface. So what sets these seemingly innocuous trades apart from others? What makes them ticking time bombs waiting to blow up your portfolio? Investors often get seduced by high-yielding investments promising astronomical returns. But when we peel back the layers, we frequently find that these lucrative deals come with a price, often in the form of hidden fees, commissions, or opaque investment structures. Take, for example, the case of Bernard Madoff's Ponzi scheme, which bilked investors out of billions between 1990 and 2008. On the surface, it seemed like an attractive investment opportunity. Returns of up to 10% per month were touted as a guarantee, and Madoff's reputation as a respected industry expert lent credibility to his claims. However, behind closed doors, Madoff was operating a Ponzi scheme, using new investor money to pay off earlier investors. This was not just an isolated incident. History is replete with similar examples of high-yield investments turning out to be little more than get-rich-quick scams. The problem lies in our desire for instant gratification and the willingness to take on excessive risk in pursuit of quick profits. As Warren Buffett once said, "Price is what you pay. Value is what you get." Yet, we often sacrifice long-term value for short-term gains, only to find ourselves holding worthless assets. Investors are often blind to the inherent risks lurking within an investment until it's too late. This may be due to a lack of research or understanding, but in many cases, red flags are simply ignored or dismissed as minor concerns. Take, for instance, the case of Fannie Mae and Freddie Mac, two government-sponsored entities that played a significant role in fueling the 2008 housing bubble. Their business model was built on providing mortgage-backed securities to investors, often with AAA ratings. However, their underlying assets were highly leveraged and carried a substantial amount of risk. Regulators and analysts have been warning about these risks for years, but they continue to be ignored or downplayed by those invested in Fannie Mae and Freddie Mac. As a result, when the bubble burst, trillions of dollars in investor wealth evaporated overnight. Leveraging is often seen as an essential tool for investors looking to maximize returns on their investments. However, it can also prove disastrous when not managed correctly. One such example is the story of Long-Term Capital Management, LTCM, a hedge fund founded by Nobel laureates John Meriwether and Myron Scholes in 1994. LTCM's investment strategy relied heavily on high-leverage positions in various markets, which initially generated enormous returns but ultimately proved unsustainable. In 1998, as the fund's assets began to hemorrhage value, it nearly took down several major financial institutions with it, requiring a massive bailout by investors and regulators alike. The consequences of this failure were far-reaching: reputations destroyed, careers ruined, and billions lost in the process. Insider trading is another significant risk that can decimate an investment portfolio. When those with access to confidential information exploit their positions for personal gain, it creates a playing field far from level. One infamous example is the case of Raj Rajaratnam, a billionaire investor who was convicted in 2011 of insider trading involving over $700 million worth of shares. Rajaratnam's company, Galleon Group, exploited its connections to major corporations and Wall Street firms to gain access to sensitive information. However, this isn't just a story about corporate malfeasance, it's also an example of how investors can be complicit in their own downfall through sheer ignorance or recklessness. When we invest without doing our due diligence, we're essentially playing roulette with our hard-earned money. Diversification is often touted as a foolproof strategy for managing investment risk. However, it can also prove woefully inadequate when faced with catastrophic events like the ones described above. One notable example is the case of Bear Stearns, which was forced to sell itself to J.P. Morgan Chase in 2008 after suffering massive losses on its mortgage-backed securities portfolio. Bear Stearns' failure served as a warning sign for investors everywhere, that diversification alone cannot shield against systemic risk. To mitigate these risks, we need to think beyond mere diversification and incorporate more robust strategies into our investment portfolios. This includes understanding the underlying assets and their associated risks, conducting thorough research, and maintaining a long-term perspective rather than chasing quick profits. The stories I've shared here are cautionary tales about the dangers of ignoring warning signs or failing to recognize inherent risks in seemingly innocuous investments. By understanding these perils and taking proactive steps to mitigate them, you can protect your portfolio from catastrophic losses. It's time to wake up and face reality. Investing is not a zero-sum game where someone else's loss becomes your gain. The stakes are far too high for that. Your financial security depends on recognizing the warning signs and acting accordingly, before it's too late. So, what can you do differently? It starts with education, taking control of your investments by understanding their underlying risks and developing a strategy to manage them. Don't rely solely on financial advisors or consultants. They may have conflicting interests that could compromise your decision-making process. Lastly, remember that investing is not just about making money, it's also about preserving what you've worked hard for. When we prioritize prudence over quick profits and integrity over instant gratification, we create a safer environment for all investors, ourselves included.